Tuesday. Ooh, almost said Wednesday, because I was thinking about tomorrow's news today. So happy Tuesday, final hour session just after 3 p.m., June 17th. Markets down on the day. Let's have a look and see how bad the damage was. I was watching some SPX levels all morning, 59.70. We did make a pretty good directional fall down there. Took a nice winner this morning, 2 winners actually. Well, 4 winners, 4 trades total for daily profit play, but 2 clusters, and did pretty well. Called the highs on the day. Price stayed out of the way. Price cooperated. Good profits by 11 o'clock, 10:30 a.m. Eastern time, and we'd be nearing full profit if you were still hanging in there for this final stretch. But 59.70, nice directional slide. We have FOMC tomorrow at 2 p.m. Eastern time with the pause. That's what's likely going to be the case. And Jerome Powell coming to the microphone of the podium at 2:30 p.m. Eastern time. So here's what we're showing so far. SPX down 0.84, SPY down 0.85. Qs, NASDAQ down 0.99, 0.8 respectively, so almost 1% on the NASDAQ, 0.85 on the S&P. Dow kind of following along, 0.81, Russell down more than 1%. Volatility is up a little bit today. Volatility up 12%. We're back into the 20s on the VIX. Back into the 20s on the VIX. A little bit elevated volatility, some uneasiness as we're coming into FOMC tomorrow. Inflation data starting to tick a little bit higher. I would expect the next maybe 1 or 2 months inflation readings to also read slightly higher. So we bottomed out here roughly in April with a this is a 1.22 bottom right there. This is April 6th. And we have now gone up almost 0.9%. So based on third-party measures, almost a 0.9% increase in inflation. Of course, we don't really know what kind of data we're getting. Because, is it possible that current economists and those that are trying to be pressured and thumbed by, Trump and company are going to try to push inflation levels lower or manipulate inflation levels lower? Maybe we do like super core CPI and try to get the target rate down to that, 2%. So it basically gives the Fed no excuse not to be cutting rates. I think the expectation is that the Fed is going to be cutting rates aggressively through 2026. If Jerome Powell pauses through September, we are looking at maybe 50 basis points this year, maybe 25 in September and 25 in December. I'm pretty sure that Trump and co want to run this thing hot. If we can get, 50 each cut or do 25 from September to the end of the year, maybe getting closer to the 100 basis points this year. We'll see. I think if Trump had his way, that would be the intention would be, cut rates, keep things super cheap, flood the economy with more liquidity, fiscal spending, monetary policy easing, and let this market run hot. So I think ultimately that just leads to a bigger bubble. But assets are likely going to benefit. I like the idea of having, non-U.S. assets, or I'm sorry, non-U.S. dollars, non-U.S. bonds in my portfolio. I think gold would benefit very well from a decision like that. I think that silver is poor man's gold, which is performing quite well right now. Bitcoin's that nice alternative as well against the entire fiat system. So I still want to own stocks. I actually took in a new account this week and started to get some positions running. So just to do a little bit of showcasing here, it wasn't anything crazy. I just got some core positions running. GLD looking to put in a 111. I'm going to label this right here. That's a 111. Establish some core positions on Bitcoin with IBIT. MicroStrategy is also a Bitcoin exposure, but a high premium trade. I put my break even down on this. Let me check my levels here. Let's go to MicroStrategy. So I've already got the break even down to 364 with a $400 covered call. So if we go up to $400, get it called away, that's $36 a contract, or sorry, $36 a share. So trying to make it an income trade. I'm going out to August 15th. I do have some protection down to the 330. I've noted that this is a debit of 1560. So if I can turn that debit into some profit, I will lower the cost basis overall. QQQ, I did establish a core position. This is a, let's see, this one is, let's double check this. The hedge, 425, 340, that's a hedge. Yep, there we go. I actually posted this today for my my profit, or it's what is it, Crash Insurance Masterclass. I posted this in my Telegram. So a 425 by 340 QQQ hedge. The debit was 489, potentially pays out, $85. So I'm not planning on taking the trade for an $85 winner. I'm planning on if I can turn a 489 into $10, $15, $20. Let's take a look at some of these key levels. So SPY, okay, we are now getting kind of a day 2 retest of this Friday low last week. I think this is going to be a critical level for this entire week. Okay, this was Friday's low. We ended last week with a low on Friday, gapped up higher on Monday, still didn't take out the recent highs. We are on the right-hand side of the trend line. Okay, so I said this yesterday. If we are breaking 59.65, 59.60, we're sweeping these lows. We're breaking this area. That low is in jeopardy. That low is in jeopardy. That U.S.-China trade agreement gap is potentially the target. That would be somewhere in the mix of like a 4 to 6% correction. If the Fed comes out tomorrow, most of the data is going to be, afternoon, 2 p.m. onwards. So I'm expecting a pretty quiet morning. I'm just going to make sure I don't get bulldozed by some kind of wild, 15 to 30 minute move like right away in the morning. But it should be relatively calm going into FOMC. That being said, I mean, this is a key low. Price may not go anywhere. It might just stay sideways and be super noisy. But a lot of times FOMC days are volatile. So we might poke the lows, but not stay there. We might poke the highs, not stay there. We might be sideways all day and nothing really happens. Powell may say something that the market gets surprised by. We might go up and break. I mean, anything can happen. There's so much volatility that is kind of willing to hit the markets during FOMC days, even though this is a pause and nothing is expected to happen. You never know. So, anytime I'm trading in the mornings, I'm trying to get in, get out, and not really have that afternoon exposure. If I do have anything running, at least in the next like 30 to 45 days, I want to make sure I have some hedges of protection on. So that's why a lot of my core positions I just established are collar trades and having some, forgiveness to the downside, give myself a big margin for error. Make sense? All right. So key level, SPX would be this 59.60 zone, 59.65 zone. Key level on the NDX is also last Friday's high. That would be the 21.6 handle, 21,600. Go to the Qs. That level, let me type these out. I'm going to put these in the chat as I'm talking here. So I'm going to go key levels to watch. I'll put key support levels. So SPX would be 59.60. So 59.60 on SPX. SPY, that low is 595. NDX would be around 21.6. It's 21,590. Qs, that low is 425. The Dow, that low last week is 421.50. And the IWM is lows on Friday would be 208. If these support levels break, there's room for the 5905, 5900 SPX liquidity tag, and also room for 4 to 6% pullbacks in the indexes, if not more. Okay, so let's post that in Telegram. So key level to watch. Now again, price could bounce off those levels, and this could be a fake out trade, right? We come down here, we poke the lows, and then close higher. That obviously can happen with some price action, so that's what I'm watching carefully for tomorrow. But I think if we slide lower than this recent low, then most likely we have some room to drop. We're clearly on the right-hand side of the trend line. We're going to see if we kind of stay there, can't make new highs. I did actually put a trade on today for oil futures. So compliments of Dr. Dad at Tasty Trade. He at least got my brain working on this trade. I didn't take the trade that they did. They did a broken wing butterfly, which was an 80 by 83 by 88. It was a broken wing that as long as price stays less than 83, the trade pays about, I want to say 12 cents credit, so about $120. And the risk is around $1,700. So what I decided is, look, I think if oil is going to have some weird spike and it's going to be choppy in here, I'm going out about 45 to 60 days and I'm putting in a trade where this is my bottom. So I decided to do something a little bit different, more risk defined. I've got $220 worth of income on the tail side. and potentially a profit trap of another $500, and my risk would be below 50 bucks. So oil futures would have to drop to $50 for me to take on any real risk. And even with that, my break even is going to be around 49.50. So I'm going to set a chart alarm here, 49.50. And I did post that trade. I think I posted that Project Options Edge. Yes. So Project Options Edge, I posted that in the service. It's a December 16th, 51 by 50.50 bear put spread with a 50 by 47.50 bull put spread, collected 22 cents credit. So expected profit is 220 bucks. Profit trap is if price is testing that $51 to $50 area. I've got a risk on there about 17.80, but a pretty good chance of profit. So I'm liking that trade there on CL. Let's take a look at currency strength today. Dollar getting a nice little nod. Pound is weak. Volatility is a little bit more elevated. We're seeing a lot of 40s and 50s on the vertical scale, now 70 and 60. So the dollar getting a nudge today. Let's go DXY. This is why I told traders don't short the dollar into these lows. So if anybody's listening out there, you're going to see the dollar getting some strength. It wouldn't be a huge surprise. The Fed is pausing. All right. Not that that's not a reason for the market to just rip higher, but the squeeze is that everybody's short position. Positioning is heavily weighted towards short dollar exposure, and I just don't want that exposure. So I'm out of the euro dollar long. It's pulling back. I actually thought this is a pretty good trade to be short and stopping about the one ATR above the 1600 handle and looking to see if this comes back down into maybe the 111 zone. So I'm not short at this time. I got rid of my dollar exposure, but looking at some confirmation on a smaller time frame, maybe getting post FOMC. We'll see if this continues to go a little bit lower. Maybe the dollar catches a bid tomorrow. And if we have a pullback in the S&P, in obviously the indexes, I would expect stocks pull back, the indexes pull back. Maybe the dollar gets a little bit of a bid. Bonds, I didn't take a look at bonds today. They are up a little bit, just a little bit though. So bonds currently up about 1.21%. Set a chart alarm here around 87.22. See if we can get past this recent interim high and see if there's any type of bid. I'll set another chart alarm. I might as well move this down here to the lows. That low would be around 83.31. So either we clear this 87.25 high, we clear this 83.34 low, and we just say choppy in the middle. I don't know. There's potentially a squeeze in this one with as terrible as everyone's talking about the bond market. I think a squeeze, could be the play. I think that's a squeeze that gets faded pretty hard. So either we just continue to put pressure, downside pressure. But as long as the Fed fights back and doesn't get too much grief, maybe the bond market stays bid. We'll find out. Also, coming into the first or second week of July, once we have this first 90-day pause that's up with the trade negotiations, I do wonder what Trump says or does. Maybe it's extended by another 90 days. Maybe it's forced everyone's hands. Maybe he has a Twitter, rampage that just shocks the world again. I don't know. I mean, it's so unpredictable. I would imagine his shift into, trying to get growth, trying to focus on growth, trying not to mess up the bond market, trying not to, disrupt liquidity. I think that's going to be quiet. So it's just hard to figure out. I'm fully expecting some type of pullback. And this has been weeks in the making now. I'm not doing anything crazy. I mean, honestly, all I'm really doing is going way down here for December hedges because the VIX is so low that it's cheap to buy insurance. If anybody's in my crash insurance masterclass, I mean, I bought a trade today on the SPY for less than $5. I bought a trade in the Qs for less than $5. So for $1,000, I have about 20 grand worth of insurance on my portfolio. I'll repeat that. For about $1,000, I have $20,000 worth of insurance on my portfolio. So even if we have a dip into this, 5750 zone, 58 to 5700 zones on SPX, if we have a dip on the SPY between 570 down to 560, I mean, I don't think the market's coming all the way back down to the lows again. But obviously, if we get some nasty direction here and the VIX picks up and we see a spike into the 30s again, I mean, we're at 21, 28 on the VIX. Is it possible that we spike up here towards 25 again? Get a little bit of risk put back in the market, so we spike up into the high 20s, maybe tap 30 again. I mean, that gets some traders' attention. Everyone's been complacent on how this market's been melting up higher. I think a little surprise, little shock, little volatility, a little snow globe effect would maybe do the market some good. As far as positioning, as far as allowing myself to position with some premium, I'd like a little shakeup. So if you have any thoughts on that, type it in the chat. Okay, what else we got going on here? Move index back down to the lows on bond volatility. Nothing here on the VIX unless we have a spike. I'll probably buy some SVXY. Oil, I just said I did a 1111 trade using this low at $50 as my risk. Let's go gold, silver. Gold is not quite at the highs. I'm going to set a chart. I'm here at 3504. Okay, I put a trade on this morning in gold as well. So what was my daily count today? I've got about 35 trades on today. GLD, I ended up going into some exposure here. This is potentially some risk. I put on some naked puts on GLD. I did a 270 and a 250 naked put. So 270 and 250 naked put. If price just goes sideways, then I'm going to pull in about $300 of income. If price goes up, I'm going to pull out about $300 of income. If price comes down, I have no risk until these strikes are actually hit and exceeded by expiration. But I would take ownership at 270. I'd take ownership at 250. Puts me at a break even of 200 shares at 260. And then I'll sell calls and I'll lower my cost basis. But if I can invest here at a discount, I think gold is also a great spot to be looking to buy long and get back up to these highs. So gold to me is if I'm buying in this at, let's say, 260 net, from 260 I'd say to $400 is going to be my profit target. Okay, so I don't know what that equivalent is, but let's say we pull back to 270 or so. Okay, let's say we pull back on gold at 13.5%. Okay, so XAU pull back 13% from current price. 13% pullback is right around this 200 moving average at 29.39. Okay, so that's area one. If we get below the 200 moving average and back above it, I think that's an awesome opportunity to be buying. I am surprised we've gone this long without hitting this this bar count. This 200 moving average is a red line. We have not touched this thing since October of 2023. So that's 430 bars. The only time I've seen a bar count that has been this high and this persistent is Great Financial Crisis. So we had a stretch from like 2009 to 2011, creeped up to, I want to say it got to like 600 bars, and then it has absolutely crashed like 25 or 30%. So, I mean, if we continue to, I mean, sideways is actually fine. If we go sideways, 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 that's fine. This could be seen as accumulation. Allow the moving averages to catch up. Any kind of funny business at the lows is probably bought back in, bullish pattern, break the structure, and then we head to new highs. So that consolidation to me tells me that the bulls are still in control. If all of a sudden gold kind of rolls over aggressively, I mean, I don't know what that would require, but let's say we roll over aggressively, find this 200 moving average. If we get a poke back above it, to me, that is trendline break, get in, position for area one, area two, try to get back to the highs, target one, and then hold on for dear life to go to $4,000 or more, target two. If you look at the last 20 plus years of S&P versus gold, gold's actually outperformed. Wasn't always the case, but because of this big bull run we've seen in 2025, the gold ETF GLD has actually outpaced the S&P. If you look at the annualized returns for, I think it's the last like 20 or 30 years. I think 20 years or so. Pretty crazy. Silver, I still like silver quite a bit. We're heading to the upside. I did buy some SLV today. SLV around 33 and change. I did this is a fresh account allocation. So SLV bought some shares at 33.62, and I have some 31.90s and 28.25s to buy more. So I'm looking to buy some dips and pullbacks if we get them. If it runs, my target's all the way up here to 44. So that would be a pretty nice gain. I didn't go heavy on this one just in case we have some pullbacks, but that is a 30+% gain on silver, which is nice to measure. And gold, of course, can run to fresh all-time highs and maybe be fantastic. Bitcoin at 105. We had some red on the day, but it's hanging in there pretty well. I mean, obviously, any type of risk-off flows, we'll see what happens. But watching higher lows, watching equal highs, see if we start to go this way. Right? Is this a ascending wedge that gets us up to new highs because we just hit higher low, higher low, higher low? But with this equal high, if we break those equal highs, it's resistance that's going to give way and off the market goes. Or is this the top? This market just spends some time consolidating, similar to what it did here, right? This is a lot of consolidation, so maybe it does that. Consolidates first, and then once it starts to get going, we clear these highs. Pretty healthy bull market could, I think. I think above 110, 112, healthy bull market. Okay. MP, what's expiry? What stock or what symbol are you talking about? For what? My hedge? My hedges, CL? What trade? Oil's up actually 5% today too, which is kind of nice. Okay, so Bitcoin I'll keep an eye on. IBIT I have some scale and levels. So I still hold some shares up here, but small, and I'm going to dollar cost average in, dollar cost average in, dollar cost average in. I may not get filled in all these positions, but if we have a little bit of chop and a little bit of accumulation, I'm hoping that I can scale in, maybe get tapped on one or two of these levels, and then break new highs, and off we go. On gold, oh, I went out to December, I believe. I think December 31st. Yep. So I did a 270, 265. So those are my two puts, 270, 265, and then I bought a put to hedge. I still took in about $3 credit. So if this pays me where price doesn't go below 270, I don't have any shares, but I've got $300 to show for it. If I do get assigned, then I have 100 plus shares, and potentially hang on to this thing for fresh highs, go to $400. I'd own it around 270 or 267 and get up to $400. I mean, that's $132, $133 per share on 200 shares. Like that's pretty good. That's 20 grand. So not bad. 270. Yeah, you can do the 270, 250 or the 270, 260. That's what I'm liking. Just a bit more premium to pull in. The reason I did the 270, 265 is because I also put in a hedge. So it's an interesting trade. I don't really have a strategy for this one. Initially the trade was I'm just going to put in some naked puts in position, but I'm like, well, if the thing drops in my 200 moving average, which I've been watching all year, that's about a 13% correction. So this debit's only 35 cents. So for 35 cents, I could potentially make, maybe this makes $1, $2, $3. And that also, helps me get a nice little profit. I'm going to take on some heat with naked puts, but if we're trading at 311 and we drop down, I don't know, 30, $40, it's like, yeah, I'm going to take on about a $6,000 or $7,000 drawdown, but at least I'll offset it by maybe $300 to $500. And then I don't have any assignment unless price is less than 270. Okay. When you hedge the SPY and Qs, I went out to the end of the year. So Qs I hedge, I went out to the end of the year. I posted that in Telegram today. Let's go to my Telegram channel. So right here. So Peace of Mind Crash Insurance Masterclass. This is a course that I teach for $197. The link is pressbirdiepup.com/insurance. You can get access. The classroom has like 3 or 4 live classes. It's really just all about showing you how to use an option chain to strategically price out cheap and cost-effective hedges. I typically take a hedge at least every half a year, if not full year. I don't make them cost very much money. I like hedges that cost me less than $1,000. Typically less than $500, and I'm looking for crazy amounts of upside. So if I'm taking, this trade, for example, is on the Qs, I paid $4.89 for it. It potentially can pay out $8,000. Now, I don't expect it to pay me $8,000 because that would mean that I've got to hold it all the way to expiration, and price would have to be below 340, which is obviously a huge dump in the Qs. But if I can take roughly a $500 risk and turn it into $200, $300, $400, $500 of profit, okay, or $2,000, $3,000, $4,000 of profit, as I've got a max here at 8,000, that still helps me offset and weather any type of drawdown. So, if prices go up and we hit all-time highs and we keep melting up higher, I'll eat the $500 and I'll make it on, MicroStrategy is going to be up $3,000 or $4,000. I've got the Qs that I'm long with a collar trade that's going to be up about $1,500. So there's plenty of income to still generate on the appreciation. And so I just had the hedges there as like a small offset. To me, this is the cost of protecting your portfolio, and I try not to make it hurt. I try not to make it sting. It's usually 1%, but it's there if I need it, and it offsets a pretty decent chunk with that type of asymmetry. This is a 16 to 1 if it pays. So if I get it to pay me 4 to 1 or 5 to 1, that's still pretty good. Make sense? So I've got that class of interested. I think this is something that at least everyone should have some understanding of. It's not that hard to protect your portfolio. In fact, I think if you want to manage money successfully, you want to manage your portfolio successfully, you have to manage risk. I've heard too many stories of traders that make so much money in a good market and lose everything in a bad market. And that's not the game that we're trying to play here. The game is we're trying to make money up, down, or sideways, right? Whether it's bull market, bear market, nobody knows what market. That's kind of what 2025 is. We don't know what this is going to be. Are we going to retest the lows in April? Are we going up to all-time highs of the global melt up? I don't know. But I do know that regardless of what the market's doing, I'm going to try to make some money. So for me, the peace of mind is, I can sleep like a baby at night knowing that at least I have let's say 15, 20, 30% of my portfolio all protected by some downside risk that might cost me 1% of my account. I can make up 1%. I can sacrifice 1% because the melt up's easy, right? But it's the the VIX spiking from 20 to 30, the VIX spiking from 20, 30 to 40 to 50 to 60. It's those type of events that we've experienced a lot of the last 7 or 8 years that traders have those booms and busts right alongside of the market, and that's no fun. Okay, so hopefully that makes some sense. All right, what else? Coinbase, nothing here. Ethereum, I don't know. I like Bitcoin better. Copper has pulled back. I'm trying to get lucky on a little butterfly here. When does that butterfly expire, by the way? Butterfly expiration is June 25th. We'll see. I mean, I guess if we get a downturn, I'm curious if copper does fall into this area. I might. Let me see what this looks like in option strat. Fudge, I don't have futures. Damn it. Does anybody have option strat with futures feeds? I guess I could pay for the tool. I just got there's a 30% off thing on option strat. I might buy it for like $210 a year. That's fine. I just want to have a futures feed because I want to see if I go out to June 20th, like, I don't know, kind of, let's say at the end of the week, what does it look like? But ideally, I know my profit trap with a butterfly spread is going to be on the day of expiration. So if we have a downturn and we're coming back to my pin price, the hardest thing for me is going to be to pin this thing perfectly at the center line the day of expiration. But if we're trading around it, maybe within the last 3, 4, 5 days of expiration, which is actually next week, maybe I can turn that. I mean, my max risk is $90. I've got a $90 risk here for about a $1,400 profit. Okay, so my goal is if I can turn $90 risk into maybe 90, 180, 270 of profit, that's a lot more than trying to hold out and get this thing perfect. That's the hardest part, is trying to get this thing perfect. But I mean, that's a pretty good return on capital. So we'll see. So I'll keep an eye on that one. Japanese yen, the inverse of the dollar yen. I'm still waiting. If I want to sell dollar yen, I got to wait for a nice clean break. 140 is the floor. Maybe we pull back to 148 again, 150 again. Dollar index, I think, is a buy off the lows. It's going to be noisy. It's going to be messy, but I think the dollar is going to squeeze up to like 101 or 102 again. Let's go to some of the non-US markets. So DAX is down just a little bit off the highs. All I did was drag a fib from low to high. So this is around a 4.5% pullback on the DAX. Okay, how about the FTSE? Just off the highs by a little bit. Argentina, decent little pullback. I'll wait on this one. China, hanging in there, but pulling back a little bit, a couple percent. Brazil, chart alarm setting above these highs. It's hanging nicely above the 200 moving average. Latin America, same thing above the 200 moving average. See if we can get this thing to clear the highs. So looking for a clear on ILF above 26. MAGs, I don't know. Maybe this is just a rising wedge. Okay, so MAGs could do something like this. If we do break this wedge, we might pull back into this gap. And this might be an opportunity for MAGs to still stay bid, stay bought, get back to all-time highs in 2025, maybe 2026. Maybe it gets a little bit uglier. Because this is so cheap, I mean, I wouldn't be surprised. Okay, there's MAGs, but what about like top 10? Is there like a top 10? I'm just curious. There's got to be something, like something stupid where this is like a top 10 ETF, which would include something like Broadcom, Berkshire Hathaway, DPS Mutual Fund, top 10 ad. I don't even know what that is. Scheme. That's a good way to list it. Nifty top 10 on Nifty. I'm not touching that thing. All right, never mind. S&P 10. S&P 100. That's not bad. So OEX. Grab the top 100. European style. It's XEO is European style. So if you trade options on this one, can I trade options on XEO? Hey. Some European style options on some XEO. Not bad. That is $29.34. That's a lot more expensive. Interesting. I wonder how liquid that is. All right. I mean, it's the exact same as SPX. It's not the same price, but it's like as far as this is top 100, so it's a little bit more concentrated, but slightly broader than Mag 7, obviously. I don't know though. I mean, the Mag 7's been treating the markets very well. We've climbed and we've rode the coattails of Mag 7 for almost a decade. I do wonder if the 493 that's still in the market is still able to produce, something relatively solid like equal weight gains, or like we saw this year. Remember, everyone talks about this market broadening idea that if Mag 7 is higher and the broader market is lower, that the Mag 7 can just lift all animal spirits to the upside, and this can just catch up faster. That to me is like La La Land. That doesn't happen very often. Usually, what happens is this outperforming to this underperforming. Usually, they catch up. What happens is this one is actually hurt worse than this one because these are already beat up so badly that that's what this year was. Mag 7 rotated aggressively. There was your 33% correction on mags while the broader market was down about 20%. That's what leveled the playing field in 2025. You had a huge rotation out of large cap tech, beat up the Mag 7 aggressively, but Mag 7 also came back and ripped, back up again, along with the broader market with a rotation. So, the bears can broaden the market out in addition to, kind of the catch-up trade. I think it's harder to get a market broadening with the catch-up trade than it is just things going down a little bit. Okay, Mohammed question, do you also have a target return per year? I don't. I never set an expectation. I really don't. I mean, honestly, I've been doing this long enough where it's like, I just take trades to the best of my ability. I trade active enough. I mean, I can't tell you the last time I had a profit target. Outside of like, I want the trade to win. Like the trade that's it. Like of the 40,000 trades it took last year, I don't know, I probably won 80+% of them, and the numbers added up last year to be about 37% profit. So could I have traded more? Could I have traded less? Could I have not? I mean, I could have done all sorts of things last year differently, but my goal is I find a trade, I take a trade, right? If it sets up mechanically, systematically, I can keep it risk defined, I just take a trade. If I'm taking undefined risk trades, which are things I typically am willing to own, like a ratio spread or naked put, I have a plan B and a plan C on those trades. That would be, set the trade up for some credit. If I get assigned the stock, I own it. I'm willing to flip it, repair it, and avoid the loss, and maybe turn it into like a $100 to $500 winner. But I allocate the capital to do that. So I don't have an expectation. So and the reason why is I think that just puts on a ton of unnecessary pressure. You're not in control of this market. All you can do is ride the coattails and don't do anything stupid. If you want to make money in the market, you got to trade with the flow of the market. I mean, the scary part is trading with the flow of the market here is I'm a bit contrarian when we're going down and the VIX is up to 50, 60 like it was this year, because probability says we're not going much lower outside of, bottoming. So we did bottom hard. We've obviously seen a nice little melt up. Could this market go higher? Of course. I think this market, if we go higher, we still have a pullback. If we roll over first, we have a chance to buy some dips in here, and then we get back to all-time highs. So, I mean, I'm going to start running a segment here probably in the next, I don't know, maybe the next month or so, that I'm just going to showcase kind of like a pro portfolio A to Z, where I talk about, do I want to trade for the day? Do I want to, generate income for the week or the month? And just kind of, I trade with what the market's given me. I mean, everybody that has a directional strategy does great with direction, does crappy with no direction. Everyone that has a non-directional strategy does great with no direction and terrible with direction. So I'd like to think of myself as a little bit more balanced. I don't need to have direction necessarily, but it's nice when I'm confident we have it. If I have confidence that the market is going to go here, then I will position for that trade to benefit with hopefully the most reward that I can get with the safest risk. If I think the market is uncertain, I will still give the market a bit more of a bias to the upside, because that's what this is designed to do. Okay. But I also want to give myself a wide margin for error just in case the market is indecisive. I can still make money down here and stay out of the way. Okay. So I don't chase trends. I don't chase highs. I don't sell, I don't sell lows. I don't buy highs. I'm not that impressed with markets that have gone straight up, because all it makes you do is feel like you missed something. So what do I do when the market's straight up? I look and see, could I have bought it right here? Right? Meaning, like, could I take a trade right here and say, if this market's going to go pull back and then go up again, I can still make income on that trade. So I did that on Palantir. I did that on HIMS. Trying to think. I did that on Oklo. I mean, Oklo's in the nuclear space running hot. I've got a trade down in like the 30s for like $200 or $300. It's like, I'm not going to chase a stock that's already, 2-3 times standard deviation moves. Make sense? So anyway, my expectations are this. I just trade like actively to the best of my ability. If I have a sense of direction, I position for it. If I have a sense of caution or a sense of more, like a neutral market outlook, I trade accordingly. And what I'm looking for is I'm going to blend, income trading with some speculation with some core positions. And if I have core positions, I'm trying to lower the cost basis. If I have speculation trades, I'm trying to, leverage options a little bit more. If I have neutral direction, I'm going to hold that, obviously for certain like mechanics. So for example, I do have a trade running right now in futures. It's one of my ES trades. This trade's it's down $70. I'm looking for a iron condor out to the end of July. I expect this market to pull back, whether it's the end of this month or early July. I think this market pulls back 4 to 6%. This iron condor should be really good. I think it should be good. Now, there's still risk on the trade. If price gets above 63.50 by July 31st, then I'm going to take a loss. It's still defined risk, but the ES market, so we'd have to go ES. Okay, we'd have to get above 63.50. Which is my sell side. So 63.50 on the call. The futures market would have to go up around 5% higher. We're going to have to go 5% higher in the next 40 some days without having a pullback. And I think that we probably have a pullback first before we go higher, or we go higher and we still have a pullback coming at all-time highs. So anyway, it's a position trade, but it's also a neutral position trade. So it's above price, it's below price, it's out of the money, and hopefully it just stays out of the money. And ideally, this trade offers me about $200 to $300 profit. That's the plan. Okay. Let's see here. Gold above the 50 EMA for 111 consecutive sessions. I'm curious to find out. I don't know. That's a good question, Lee. I mean, that's interesting on gold. I think that, above the 50-day, that is a lot of sessions. This is a 21. This is a 50. This is a 100. That's a lot above the 50-day, but it's also a lot above the 200-day. I've got over 430 bars, I believe, or right at 430 bars on the 200-day. To me, that's a pretty proven strategy where we're at around 430 bars. I don't see daily charts going too much higher than that, too much longer than that, without having an inevitable crash. And maybe it's not a crash. Maybe it's more of like sideways. We cap the highs. And that's where I think this is going to be very boring for gold traders this year, is maybe the gains are already in. But the one thing you don't want to overlook is, look, an accumulation phase in gold is actually great. It really is. Because if we just go sideways, it just shows that the bulls want more of it. And they might hold this control, and then you get an opportunity to buy low, gets back to the highs, goes back to all-time highs. Off we go. But as long as we find this 200 moving average and check that box, then I'll stop complaining about not buying gold. But if this goes higher, I'm just cautious that we end up having a correction so severe that we come back and still find the 200 moving average. And I was wondering this year, like, are we going to have like a COVID crash? Because that's what happened in 2020. You go back to 2020 with gold, take a look at the price action. Okay, gold was right here. What did gold do in 2020? It crashed hard and then ripped higher. I mean, look at that run post-COVID. So we had a correction of around 15% within a month. And from that bottom, which is back to the 200 moving average, mind you, from that bottom to top, gold rips up about 42%. And that was done within what? 100, it's not even a year. I mean, you roughly have 250 trading days. I mean, you're talking half a year for that thing to rip up 42%. It's better than the indexes. It's crazy, right? And then we go sideways for several years. So hit the peak here in 2020. This is August, so we go sideways for several years. But you still have opportunities to find support, and then gold again, off to some highs. And this has been like gangbusters. This is crazy, like above this COVID rip. From the COVID bottom to now, I mean, gold's up 140%. It's pretty impressive. It's not perfect, but this last little stretch from the bottom in 2022, gold's been pretty awesome. Make sense? All right. Okay. What else you want to talk about? Got a few more minutes. JP says anything tomorrow. Wouldn't be surprised to see 3,500 fairly soon. I mean, what is Jerome Powell going to say that is going to really rattle the markets? I mean, his job is not to rattle the markets. Everyone thinks like, oh, the Fed's going to bring all this volatility. His job is not to bring volatility. His job is to maintain stability, maintain control, maintain some confidence. I mean, the only thing that he's getting a lot of grief for is not cutting rates. Well, he's not cutting rates because we're right on the cusp of weaker employment and higher inflation. We really are. I mean, I keep saying that we're not going to see a recession until we see jobless claims go up. But look what's happening. If you go to jobless claims or continued jobless claims, we are starting to notice that trends are going higher. So this is initial jobless claims, which doesn't look like scary. It doesn't look concerning. Okay, but look at initial or continuing. Sorry, look at continuing. You zoom in on continuing. Look at this recent spike. That's not nothing. Like that might be something small, but it's like, look, one data point doesn't make a trend. But if we go this spike and then another spike, I mean, that's going to be a little bit more of a rate change than we've seen for months. So, I mean, I really don't want to see this thing get above 2 million. If we get continued jobless claims above 2 million, that's not good. This is starting to tick higher. So, something to be aware of. Also, core PCE. I think out in here somewhere, there's core PCE price index. No. There is our unemployment rate. Here's our core PCE. So we're trading at 2.5 core PCE, and our federal funds rates is still up here between the 4.25, 4.5. So this is the restrictive rate that everyone's complaining about. Core PCE is so much lower. Inflation's nothing. Donald Trump says inflation's nothing. Well, trueflation begs to differ. Trueflation says we're at 1.22 from April this year lows. We're back up to 2%. That's a 0.8 to 0.9% increase. If that starts to show up month to month in data, we go from a headline CPI at 2.4, maybe back up into the high twos, maybe back up to 3+%. So what is Powell trying to do? Keep the market stable, not rock the boat, and don't cut rates as inflation might flip above it. Right? How much more problematic would it be if all of a sudden we have a rate at 4.25 and we have inflation at 2? Let's do the math here. Okay, what happens if our Fed rate is 4.5% and inflation is 2.5%? Let's say the Fed starts cutting rates aggressively. He listens to Donald Trump. He bows to the ring or whatever, and we cut rates by 50 basis points here and another 50 basis points here. Meanwhile, inflation data starts to go up. That is not going to be good, because what's the Fed going to have to do from there? Probably backpedal and start raising rates again. So at the very least, look, if we just have a bit of a slowdown, here's the important thing. Think of the U.S. as a giant plane, okay? And we're flying. As long as we can maintain altitude, we will be fine. So don't have a ton of job losses. Don't see crazy high inflation numbers. Don't hurt the consumer too badly, right? Stocks stay stable. They don't have to go, look, stocks don't have to rip. They don't have to rip 20% higher, but they can't crash 10 to 20% either. So we need to maintain altitude. Does that make sense? But if that altitude is maintained, all of a sudden we start hitting a stall, that's when they can turn and nosedive, and all of a sudden we're heading down towards the trees. That's my best analogy, kind of explain why I think Jerome Powell and the Fed are still maintaining high rates. Because if they start to play the game of cutting rates with a world that might see higher inflation and higher yields, it's going to be an inversion that we don't want to deal with, because we're going to have to reverse again. And that's gonna like make the Fed look like crap. They've already had questionable credibility, for a long time, just because they're so reactive. But last year when they cut 50 basis points in September, the market didn't like it. They said they should have, done more. They should have done less. Nobody's happy with them. But I just think that if inflation rears its head again in an unsavory way, you're going to start losing the consumer too. If you lose the consumer, you damage GDP. You damage GDP, we are talking recession. We talk recession, we're talking job losses. It's like it's a slippery slope that can get really nasty out there. So I agree with what Powell's doing. I think that the Fed needs to stay independent. I think if we want to keep seeing higher highs in the markets, then yes, we probably have to cut rates. But it is a way bigger concern for the consumer to see higher inflation hitting everyone's wallets and feeling like you just can't do enough to get ahead. But a good way to combat inflation is to be an investor. Hold assets, hold the stock market. It's probably going to melt up higher. So regardless of if we get aggressive inflation or no inflation, again, as long as we can maintain altitude and not stall and head to the cliffs or the trees, we'll be fine. But it might be a year of just trading. It might be a year where the S&P returns less than 10%. It might be a year that turns like literally 0 to 5%. Not a lot of investors would be happy. But remember, you just took a 20% drawdown from peak to trough in order to make a single-digit return. That risk-adjusted return is that's part of the game, but it's not fun. It's not fun to just have money tied up and invested and making no returns. Meanwhile, you're dealing with a lot of risk when the market is down. So anyway, there's my PSA rant for the day. Rate cut September is what the markets, I know, and that's still the case. I mean, as far as probabilities go, okay, that's still the case. I'm going to the watch tool right here. Come on, watch tool. If anybody has the screenshot of the watch list, I'm trying to get the probabilities up just to see what it's baked in for tomorrow. It's probably like a 95 to 97% chance that they don't do anything. I guess I'll Google it. CME Fed watch tool. Huh. The Fed website's broken. Donald Trump shut it down. I don't know. Anyway, it's pretty much baked in that there's no cut. It's going to be paused tomorrow. Okay, and the pause is expected to be September and December. So we would have a pause in June. The next FOMC is July 30th, which to me is going to be one of the most interesting Fed meetings this year because it's right after this trade war pocket of 90-day pause. It's kind of an interesting, like, low liquidity, low volume summertime. So the market is like pretty vulnerable through like July, August, September, because usually you have the September effect, which means you have a little bit of a lull coming out of summer trading. But the market typically has lower volatility when everyone's on vacation and kind of slowing down. That the market can do some tricky things. So, last summer, July to August, we had a pretty nasty spill. The market was down almost 10% for like a 30-day window. And that's why I think these like OPEX cycles are important. We get to June 30th. Are we down to 5,900 or are we up to 61, 6,200? Either way, I still think a correction is coming. It's just which comes first. I'd obviously like to see a correction that I can buy into as opposed to getting some all-time highs you have to fade. That doesn't feel good. To like accomplish this milestone of we had a 20+% drawdown, market gets back to all-time highs, and yet it doesn't have the momentum to sustain those highs. I'd rather have a dip first to allow institutions to position, allow the bigger picture to say, hey, this is a safe spot to buy. This is a good time to buy. It's hard to want to fade the market. It doesn't pay very well. So, I mean, anybody that's been a perma bear, you're probably not much of a trader because I don't know what you're doing. Unless you only want to place a trade once every 2 to 4 years. If you're a bear trader, then you're trading probably twice, maybe every 2 to 4 years, and you get paid. Other than that, you don't do anything. You just sit and wait. But if you are an investor, this market finds a way to go higher over and over and over again. And honestly, it's a great wealth generator, and it's used to transfer assets to those that have it and get more of it. So it's just a huge accumulation phase. All right, 99.9% chance. Is that right? Wow. All right, well, that's why I put here in Discord. Tomorrow's news today. Fed won't cut rates. They're not going to cut rates. They're probably not going to cut rates until September. And that's an if. Because what are we going to have from now until September? Well, we'll see if the market can stabilize. Maybe the market dips a little bit. We'll see what Trump says about this trade war. Maybe we kick the can down the road another 90 days and open up this negotiation window once again. We get into September. I mean, this is the big air pocket that everyone's talking about where we're going to have like those five-year refinances coming back. It could be corporate refis. It could be the Fed having to roll debt. It could be, are we going to see the Fed cut rates and have the bond market react the opposite way like it did last year? So if we cut rates by 25 basis points, does the bond market, the yield market, react by 25 basis points up? So if yields go higher and bonds go lower, Fed cuts rates, that's not a good sign. That's the exact same crap we dealt with last year. What was the opposite, right? I mean, you would think from a 40-year cycle of monetary policy that the Fed cuts 100 basis points, which they absolutely did last year. Mortgage rates have not changed. Isn't that crazy? Okay, so the 30-year mortgage rate is around 6.85. When the Fed cut last year, it would have been down here. When the Fed cut, I mean, this is funny because a lot of realtors were telling people like, wait it out until 2025. Hold until 2025. We'll get there. We're going to see rate cuts. I mean, look, I thought it too. I started bidding for a house and I was ready to buy. And I mean, I closed with a 6.6% rate. I'm not thrilled about that at all. Last house I had was 2.72. Big difference. Big difference. Okay. But we cut rates right here and the market did the exact opposite. So we are nowhere near those lows. This was offering, I mean, this is like a 6% mortgage. Okay. Obviously, COVID. I mean, and I just don't want. I know that what this is doing is this is making the current housing market unaffordable, right? The average house is 6 times salary when it used to be historical average about 2 times salary. So we have higher rates, higher prices. Right now, it is a bit more of a buyer's market because there's a ton of houses sitting on the market waiting and not moving. But the overall, ratio, it's really, really unaffordable. It's way worse than it's been ever. 6 times salary to buy a house. 40 to 50% out of pocket gross revenue to own your house and pay for your mortgage. On top of that, homeowners insurance is more expensive. On top of that, utilities are more expensive. On top of that, getting renovations and doing DIY handy stuff is more expensive. Owning a house is more expensive than it used to be, but let alone just the sticker price, let alone just the interest rates. Not good. Okay. But we still have about 70% of the US is less than a 5% mortgage. So 70% of the US is still sitting at a sub 5%. And we have a nice chunk of that, probably 3/4 of that 70% at a 4% or less. So a lot of people are fine with their current mortgages. The problem is they can't move, or they don't want to move, because why would I sell a house at 4% interest and go buy something at a higher price at a 6 or 7% interest rate? So it doesn't make a lot of sense. I mean, like money wise, it doesn't make a lot of sense. But my point is, if the Fed cuts this year, okay, let's say the cash rate goes down by 50 basis points. Okay, 50 basis points. Do the yields go up another 50 basis points? If that is the case, that is not good. Okay, it's not good. It just makes growth harder. It makes growth more expensive. That's going to make a lot of companies struggle. That's where the big worry is that we can't grow our way out of this because things are just too pricey. So this whole idea of Donald Trump saying, hey, cut rates, cut rates, cut rates. We don't have any inflation. I'm telling you, if we cut rates and the bond market tells us otherwise, there's a saying out there that I think is really important. The government will spend as much money as it can until the bond market takes away the keys. So, I mean, everyone might hate the bond market for just like, oh, it's garbage. The TLT's down for a 5-year drawdown. The bond market is also going to tell the market whether or not it should or could or can, cut rates, not cut rates. Can it grow? Can it not grow? I mean, we saw the muscles flex in the bond market this year in April. So if we cut rates this year and the bond yields go up, I'm telling you, that's not a good sign. The rate of change, depending on how quickly the rate of change is, that could also be a lot of growth that's going to suffer. So this theory of we're going to grow our way out of it, well, not if rates are higher, right? Not if the Fed cuts, but nobody can borrow at a lower rate. I mean, that isn't crazy. The Fed cuts by another 50 basis points. We're down 150 basis points from last year, and yet yields are higher. It's because all yields across the globe are going up. The bond market is basically looking at this and saying, look, this is inflationary. This whole landscape is inflationary. There's nothing the Fed can do. The Fed could cut, maybe the bond market's trying to say the Fed could cut to 2% right now, from 4.5% down to 2%, and yields could go up the exact same amount. It's never really happened before, but it did happen last year. So I think we have some really interesting like anomalies and non-correlations that are I think we have to pay attention to them. So anyway, all right, closing bell is in. Let's get the tail of the tape. What do we have? S&P down 0.84, SPY 0.85 at 597. NASDAQ Q's down 0.98, NDX down over 1%, Dow at 0.74, Russell just over 1%. VIX is up on the day, 12% of the VIX coming into the Fed. Again, this is a pretty interesting spot for tomorrow. Fed meeting, are we going to take out this low? I mean, I wouldn't be surprised tomorrow is if either the market is going to go down through the Fed or it's going to go both ways. Maybe it's a big indecision candle tomorrow, but I'd still be looking at this as let's say it's a noisy day tomorrow. This is just hypothetical here, but let's say it's a noisy day. If we have an indecision candle tomorrow, okay, I would wait for that high or that low to break for any type of direction. I know it seems weird to buy the highs, but if we break those highs, we probably have momentum to get to all-time highs. If we break the lows, we have that 4 to 6 to 10% correction area to pull back and, offer some levels. 5,900, I keep watching. If we sweep this low at 59.60, I think 5,900 is very doable by the end of the month. Make sense? All right. If I don't have any other further questions, I'll let you go for today. Good stuff. Good discussion. Tomorrow, let me see if it's on the to-do. So I'm doing a trading battle tomorrow during FOMC. Get ready for FOMC. What's on tap here? Here it is. 9 a.m., 9 a.m., 11 a.m. Okay, so I'll post the link in my Discord channel tomorrow if you'd like to join me. It'll be myself. I'm battling it out against Blake Morrow, a good friend of mine at Trading Analytics and Forex Analytics. Nick Syke with A1 Trading is hosting. 1:30 p.m. will be live for FOMC, talking through a couple of trades, what we're going to do. I mean, I'm going to try to do a lot of pair trade, try to net profit, and try to win the battle. But that'll be tomorrow at 1:30 p.m. So it'll be a fun live session, live trading. And we'll sit there and watch the price action, watch the fireworks when it comes to FOMC tomorrow. Okay, all right. And that's being said, why did ANET drop? I don't know. ANET is Arista Networks. We're down $5. There's the headline right there. So there's a new president COO. Healthcare stocks retreat late afternoon. So is this in healthcare? Electronic tech? Yeah, I don't know. I mean, go to FinViz, look at real-time news, and see if anything pops up on ANET. I'm sure there's some headlines for the day. Okay, I'll come back and see you all tomorrow. Thanks, everybody. Take care. Bye.